Stop. If you're under 30, this video could make you thousands or cost you millions, depending on whether you watch until the end. Because one of the 5 mistakes we're about to cover quietly steals more wealth than bad investments, recessions, or even low income, and almost nobody talks about it. Not your school, not your parents, not even most finance influencers. But by the end of this video, you'll see money completely differently. And mistake number 4, it's the one that traps high-income earners for decades. Let's begin. Here's something uncomfortable. Your 20s are not a trial version of life. They are the financial foundation of your 40s. And here's the brutal math. If you invest $300 a month starting at 22 and stop at 30, you could end up with more at 60 than someone who starts at 35 and invests double. That's the power of time. Not talent, not luck, time. But most people under 30 unknowingly sabotage that advantage. Let's break the cycle.
Mistake number 1, thinking income equals wealth. I know someone who made $120,000 at 27 and had less than $3,000 saved. Meanwhile, another person earning $45,000 had a 6-figure investment portfolio by 30. Why? Because income is how much you make. Wealth is how much you keep and multiply. What's the real difference between rich-looking and actually wealthy? It's this. High earners often upgrade lifestyles faster than they build assets. New car, better apartment, designer labels, expensive brunches, vacations financed on credit. And suddenly, they're financially fragile. After studying behavioral finance patterns across thousands of households, one pattern shows up repeatedly. Lifestyle inflation expands to consume income unless intentionally restricted. Wealth builders automate investing first. Spenders automate lifestyle first. And this connects directly to mistake number 3, which is even more dangerous because it feels responsible. But before that, mistake number 2. Avoiding investing because it feels risky. Let me challenge you. What's riskier? Investing in diversified assets over decades? Or keeping all your money in cash while inflation erodes it silently? Most people under 30 delay investing because, I don't know enough. The market is scary. I'll start when I earn more. Here's the psychological trap. Uncertainty feels dangerous, but inactivity is often more expensive. A 24-year-old decides to wait until 30 to invest. Those 6 years, gone forever. You can't retroactively compound. And compounding isn't linear, it's exponential. The first 10 years often look boring. The next 20 look unbelievable. What if the biggest risk isn't market volatility, but hesitation? And the next mistake is why even people who invest still struggle to build wealth. Mistake number 3, saving without a system. This one sounds smart. I save what's left at the end of the month. No, that's backwards. Wealthy behavior looks like this. Invest first, spend what remains. Most people spend first, save what remains. And what remains is usually nothing. Humans adapt upward instantly, but resist downward painfully. If you wait to see what's left over, your brain will expand spending to fill the gap. Automation removes emotion. Financial research consistently shows that automated investing dramatically increases long-term asset accumulation compared to manual saving. Systems beat motivation. But now we're entering dangerous territory, because mistake number 4 is the one that traps ambitious people, and it doesn't look like a mistake. Mistake number 4, building a lifestyle around 2 incomes. This one is controversial, but stay with me. When your fixed expenses require 2 full-time incomes to survive, you've eliminated margin, and margin equals freedom. Imagine rent based on combined income, car payments based on combined income, vacations financed on combined income. Now remove one income. Suddenly, stress increases, flexibility disappears, career risk feels terrifying. Why do so many couples earning good money still feel financially stuck? Because their cost of living grew faster than their financial cushion. When your lifestyle requires maximum effort to sustain, you become risk averse. You don't negotiate salary boldly. You don't switch careers. You don't start businesses. You protect survival, and that protection limits upside. Financial resilience studies repeatedly show that households with lower fixed cost ratios have significantly higher long-term wealth accumulation and lower financial stress. It's not about earning more, it's about needing less. And finally, the fifth mistake is the one nobody wants to admit.
Mistake number 5, identifying as a consumer instead of an investor. This isn't about money, it's about identity. Ask yourself, when extra money enters your life, do you think, what can I buy? Or what can I own? Consumers trade money for experiences and status. Investors trade money for assets and leverage. Here's the shift. Consumers look at price tags. Investors look at return potential. Consumers upgrade phones. Investors upgrade portfolios. Story moment. 2 friends get a $5,000 bonus at 28. One buys a watch. One buys assets. Fast forward 20 years. The watch depreciated. The assets compounded. And compounding doesn't just grow money, it grows options. Identity drives behavior. If you see yourself as someone trying to manage money, you'll behave cautiously. If you see yourself as an investor, you'll prioritize ownership. And ownership changes everything. Let's zoom out. Before 30, your goal isn't perfection, it's positioning. Positioning for compounding, optionality, margin, identity growth. The people who look lucky at 45 often just avoided these 5 mistakes at 25. Wealth isn't built in dramatic moments. It's built in repeated, boring, disciplined decisions. And here's the part most don't realize. You don't need to be extreme. You need to be early. Remember the mistake I said steals more wealth than low income? It's delay. Delay in investing. Delay in building systems. Delay in thinking like an owner. Time is the only asset you cannot earn back. If you're under 30, you're sitting on the most valuable financial advantage in existence. If you're over 30, you still have time, but less margin for delay. So here's your move. Pick one mistake you're currently making. Fix it this month. Because your 40-year-old self is either building freedom right now or building regret. And the difference starts today.